Great, thanks, Mona. It gives me great pleasure to introduce Gary Brandeis. Gary is the founder and president of Scholar Hotel, a group that specializes in both developing and operating hotels around colleges and universities. Gary's career in real estate goes back to 1990. He bought his first hotel in 2006, and he's got a tremendous amount of experience, both as a CEO and also in terms of developing a business. So we're delighted that he's taking the time to be with us today and have a discussion around how he's built the business, some of the lessons he's learned, and how he's dealt with COVID and his perspective on the world of hospitality in going forward as we sort of come out of COVID. So with that, I'd like to get started with Gary. So Gary,
morning.
Good morning. Be great if you could give us a bit of background. I mean, you obviously made the decision to start focusing in terms of developing hotels in around colleges and universities, and you sort of built that business from scratch, soup to nuts in terms of finding sites, developing, and ultimately operating the hotels. Be great if you could sort of give us some background in terms of how you got into the space, what attracted you to it, and some of the sort of lessons you've learned as you built the business up.
Sure. Well, thank you, Andy, and thank you for the opportunity to speak today. I really appreciate that. I really enjoy doing these types of events. I like interacting with new people and having the opportunity to share our story, which I think is a unique one. Although I think if you're an entrepreneur or in the private equity space, hopefully a lot of the things we'll talk about will resonate. So basically, first of all, I was happy to see that Penn State Great Valley is one of your sponsors. I'm a Penn State graduate. I graduated with an accounting degree. I spent a couple of years working at one of the big accounting firms, passed my CPA exam, and then decided that I didn't want to be a CPA for the rest of my life. Got into the real estate business because I had a lot of real estate clients at Price Waterhouse where I worked, and really just sort of cut my teeth, sort of in the fundamentals of real estate for, almost 15 years or over 15 years or so. And I think that enabled me to start the business that we have today back in 2006, end of 2005. So we're a real estate investment company and developer, and we're really a fundamental investor. We're a real estate first investment company. And I think what happened we got into the hotel business by accident, if you will. We had an opportunity to buy a property in the Philadelphia area. And really, we wanted to buy it because it was a great piece of real estate. It wasn't a hotel. It happened to have a hotel on it, but it was about 5 acres of land in a A+ location. And the value that we were paying, or the dollars we were paying for the real estate, made a lot of sense whether we kept the hotel or didn't. And so we decided, after acquiring the property, that we were going to keep the hotel, even though we could have taken it down and developed residential, retail, office, or anything in between. And we decided to keep the hotel, and we hired a third-party manager. We renovated it. And what I really liked about the hotel business, as opposed to other types of real estate, was you did all the same things that you do in the real estate business. You're buying a hard asset. You're doing physical investigations on the real estate. You're doing market analysis, and you're looking at all the things that any of us would look at when buying a business. But what I liked about it was that when you operate a hotel, there's really an operating business that sits on top of the traditional real estate business. And for me, spending most of my career up to that point in the office, industrial, and retail business, it was something that added a new dynamic to the business. And I like the idea of operating a day-to-day business when you're dealing with what you might experience when you invest in a manufacturing business or a software business or businesses like that. So having the combination of an operating business and real estate was really attractive to me. And that's really what pushed us into the hotel business. And then in 2013, I had the opportunity to buy an acre of ground, which was a rectangle, in downtown State College, Pennsylvania. If everyone knows where that is, it's sort of where it's called Happy Valley. I consider it Happy Valley, but It's right across the street from the Penn State campus where I went to school. And going back to the early 80s when I started college, I couldn't remember a time where I even saw a storefront for sale, let alone an acre of ground, with a parking lot on it. And we basically, myself and a partner, bought that land. I think we closed in 2 weeks, because we knew how valuable that property was, being so close to the college, to the Penn State campus. And we knew that, this was a rare and unique opportunity. So we jumped on it. We acquired the property, and then we started working very quickly to put together a development plan. And we did a lot of things. I think, in hindsight, we did a lot of things right. We certainly made our mistakes along the way. But what we realized is after we went through the development process, the construction process, and we basically built the first new hotel that was within walking distance to the campus in almost 30 years, which was a strange phenomenon. And frankly, couldn't really understand why nobody had built another hotel, especially when you saw the growth of the university over 30 years. But nonetheless, we built a hotel. We built some retail as well. We got Target and H&M in the building, but we built a 165-room Hyatt Place hotel. And I would tell you that when we underwrite these deals, we're fairly conservative. We want to make sure that we can hit our numbers and do it in a way that is very manageable. And we try to underpromise and overdeliver as a developer. And I would tell you that when we opened the hotel and for the first 12 to 18 months, we far exceeded any expectations that we had. And what we also learned was that as you looked at sort of the demand curves for that specific hotel, that our business was very dependent on the university. And in this case, that was a good thing. It wasn't like we were dependent on a single business or industry. And we felt that owning this hotel within the walkable community to the campus, and if you look at the university calendar, which is very consistent and reliable, that we can really benefit from that. And in addition to that, and probably the key point here is that we almost took a lot of the risk. I can't say all of the risk, because there's certainly risk in everything, but we took a lot of the risk out of a traditional hotel investment. We took it out of the equation because we had this $5 billion university that had almost 50,000 students and had a very consistent calendar, move in, move out, sporting events, parents events, alumni events, recruiting, prospective students visiting campus. So anyway, the idea of partnering or depending on the university, a major one like Penn State, that also has about $1 billion a year of research and development, really took a lot of the risk out. And we started just seeing the benefits of being so close to the university. And then we started to look outward a little bit and started to realize that, in talking to friends, my kids were getting ready to go to college and realizing that a lot of these smaller communities that were supported by major universities really had kind of a lousy stock of hotels. And I think if any of us have kids that went to a college where, it wasn't in a big city, it wasn't in Philly or Boston or DC, but in a college town like State College or Ann Arbor or Athens, Georgia, or Gainesville, Florida, places like that, that the stock of hotels were not great, number one. Number two, a lot of them, and if not most of them, were owned by local owners and operators, mom and pop operators, if you will. So we thought, hey, if we can build a portfolio of hotels in and around college markets and take advantage of sort of the lousy competition that we would have in most of the markets, that we could really do something special and interesting and create cash flow and net income from that portfolio that potentially eliminated a lot of the risk potential that you have in traditional hotel investing. So that's really how we started. And I think we started the right way. We started organically. We started by having the opportunity to do a ground up development in a market that we really knew well. And so it wasn't like we were going into a community or a market that we didn't have any experience with. We didn't understand the dynamics of. So we got to sort of cut our teeth, if you will, in this specific submarket, a subcategory, if you will, of the hotel business, and really learn it that way. So then when we went into our second college market, which was Morgantown, West Virginia, where West Virginia University is, also a smaller community with a big state university, we obviously got a little bit better at that point. And then our third community was in Syracuse, New York, where we bought 2 properties, and we were benefiting by Syracuse University, which is a private university, but about 22,000 students. But we also were benefiting from Upstate Medical University, which was the SUNY, or the State University of New York's medical college, cancer center, children's hospital, and the properties we bought were literally right in between those 2 properties. So again, we were sort of using that same business model of, we can buy really great assets, kind of tired, not operated as efficiently as maybe we could do, and put some capital into them, bring them up to what we would consider more institutional standards, and then really execute well on the operating side. So real estate first, making really good real estate investments, focusing on traditional real estate fundamentals, location, the quality of the property, looking at deferred maintenance and where we needed to spend our money to maximize the value of the real estate. And then coming in with our operating team, we built our own management team. And I think that's really important in the hospitality space. And I think what we've learned during COVID, and I know we'll get into COVID a little bit later, but what we've really learned in COVID, and I can talk to you about the impact on our business, but what we really learned in COVID is that in the hospitality space, because of that extra layer of operating business that sits on top of the real estate, being an owner operator and being a smaller company really is probably, I think, the best way and maybe the only way to really succeed in hospitality. So what that allows us to do, and what allows me to do as the business owner, is it allows me to stay really, really close to the real estate. It allows me to stay really close to my operating team, and it allows me to collaborate with them and make sure that we're doing everything we can to, maximize our revenue, eliminate as much downside risk as we can, and then also look out for the sort of the overall business plan. So it's something that's resonated really well with our investors, and it's worked out really well. Now, obviously, if you asked me sort of about my business, like the first week of March of 2020, I would have told you that March was going to be a pinnacle year for our business. Our budgets and projections for our hotels in 2020 were really strong and really favorable. We had 3 deals under contract to acquire and develop or redevelop. We had just opened our properties up in Syracuse in early February. We had acquired our second project in State College and had development plans ready to go for that, and a property in Florida, a property in Virginia. And so we were really, really, really excited about 2020 and really excited to get started. And then in mid-March, we kind of, well, Andy, maybe you want to get into that now, but
yeah, well, let's get into COVID in a minute. Just 2 things. Firstly, I know Bob's just put a question in the chat, and we'll get to that. But if anyone has any questions for Gary, we'd love to get them in the chat room, and we'll pick them up. But yeah, just before we get into COVID, Gary, I mean, obviously the first property you did, and I was never aware that you bought it in 2 weeks. So I'd be interested to know how much you'd actually planned out what you were going to do before you bought it, because 2 weeks isn't very long. But also, obviously, the first property you developed was a Hyatt branded property, and since then you've developed your own brand. And so I'd just be interested as to what drove you to move away from the major brands and run your own and develop your own brand, and how you see the value of that, really.
Sure. It's a great question. When we started the State College project, so we bought it in 2 weeks, which is a true story. And really, it was a parking lot. So there wasn't a whole lot to look at from a physical perspective. We knew that anything that we were going to do there was going to be new ground up construction. And really, the biggest risk that we saw was environmental. Fortunately, the seller had a very recent environmental study, so we were comfortable that there weren't really anything under the parking lot that would have caused us some heartache from an environmental perspective. And going to college there 30 years prior to that, I sort of knew it was on that site, and the environmental report got us comfortable. So yeah, I typically would never do that, obviously, especially with an existing asset on top of on top of the land. But in this case, because of my knowledge of the market, because we had the environmental study and so forth, we were able to do that. The reason we ended up with Hyatt in State College was because the project itself was about $55 million of total cost. And when you're looking for construction financing of that size, most lenders are going to require you to partner with a major hotel chain. And so it would have been much more difficult for us to get financing for the project if we weren't connected with one of the major brands. Now, when you looked at the market, there was already a Marriott. We were looking at limited service hotel, which are Marriott Courtyards, Hilton Garden Inns, Hampton Inns, properties like that, Holiday Inn, Holiday Inn Express. So all of those brands, they were already one of those hotels in the market already. And so Hyatt Place was really just getting started. It was Hyatt's version of a limited service property, which limited service basically means it doesn't have full service food and beverage and potentially doesn't have full service conference and meeting facilities. So in order to secure our construction financing, we were sort of pushed into signing an agreement with Hyatt. And I think it's been fine. I think, Hyatt's good to work with. They're a good company. They give us a lot of flexibility and don't sort of, don't have their thumb on my back all the time. But that said, as we got further as we opened the hotel and we saw where our business was coming from, frankly, the flag, what we call them flags, the flag wasn't providing the same level of business to our property as it would in a traditional market. So in a traditional market, a non-college market, the flags are going to probably bring you somewhere between 45 and 55% of our business through their reservation system, their loyalty programs, and things like that. And if you're in a market like Philadelphia, where we have a Marriott Courtyard, you really depend on that brand to bring you the business. In a college market, especially a smaller community with a big university, we knew where our business was coming from. We knew how to go after that business. And we can if you want to talk about social media, we can talk about that too. But social media allows us to really target market our audience and our potential customer base. So as we looked at doing more of these college sort of oriented, university oriented hotels, we didn't think that the brands were as important to us as they would be in a traditional market. And so we went into West Virginia with our second college property, and we developed our own brand called Scholar Hotels. And so we have a property in Morgantown, right downtown. At the time, we were the only hotel in downtown Morgantown that was walkable to campus. And we felt really strong that, we felt very confident that we could redevelop the property. It was an existing property. We redeveloped it and we put the Scholar name on it. We got the domain. We started the building. We started the business from scratch. We bootstrapped it and we got our first Scholar up. And it takes a little bit of time to get a hotel off the ground. It's not something that happens overnight, but we started to build some loyalty. The renovations resonated with the college community and the college campus and the parents and the professors and people visiting campus. And so we started to see the benefit. And then we did it again up in Syracuse. In Syracuse, we bought two properties. One's an extended stay hotel, and the other one is a more traditional transient hotel. They happen to be on the same parking lot, but they're two separate buildings. And so we did it again. And again, we saw the benefit of knowing where our customers were coming from and not necessarily needing the wide marketing and the national and international brand loyalty to really get our fair share of the market. So that's why we did it. And I think as we move forward, we're starting to see a lot more focus in the college market. So we're getting a little bit more competition now. There's another brand called Graduate Hotels that has a lot more properties than we do. But we're a real estate first company. They're more of a hospitality company. And I think in the long run, I think our strategy is a good one in the sense that our first goal is to make a good real estate deal. And that means making sure that we have the right location and even as important, we have the right basis. Our investment structure is going to work. And again, when you think about college markets, we think they're a little bit more insulated from the general economy, the ups and downs of a general economy than a traditional hotel. And that's when I said earlier that we felt that hotels in these college markets, a lot of the risk is taken out of the hotel model. And that's a result of connecting with the major university or college.
Just picking up on one of the questions out of the chat room. I mean, do you typically have a formal relationship with the college or university, or are you sort of completely independent of that? Or is this how you sort of build some of the stuff with social media?
Yeah, so it's really independent. We're not, obviously the university doesn't own any part of our business or the particular property. So it's incumbent on us to go out and make sure that we form those relationships. So in State College at Penn State, where I went to school, it's been a lot easier for me to do that there. However, we're doing it in Morgantown, we're doing it in Syracuse. I speak at, real estate classes, hospitality classes. We're involved with alumni events, and so it's really important that one, we connect with the university, and at all levels. We hire students to work at our hotels, and internships and things like that. So it's really an independent business, but we want to make sure that we're really connected to the community, and that's really important in any hospitality asset. Our doors are open 24/7; they never close. We're a community asset. We're not an office building where we're really just for the office tenants. Our doors are always open, and people can come into our hotel and maybe just simply buy a cup of coffee and hang out in our lobby, right? So that's our customer, as well as a customer that might be staying us with for a few days or even a few months, depending on where you're staying. The Scholar, we just built our fourth Scholar in State College, close to the Hyatt, and that's an extended stay property. All of our rooms have kitchens. So we're looking at really building a different customer base with that model. And I think as we build our business and we grow our business, we're going to have some traditional what we call transient hotels, and also extended stay hotels. And it's going to depend on what we think where the market opportunity is. And the other thing that I failed to say, Andy, especially for this group, private equity, is that we're a vertical. So we do everything from raise our own capital all the way up to investing it, developing projects, redeveloping projects, and then operating those projects. So in the last 11 years or so, we've raised 3 private equity funds, and with institutional owners, high net worth individuals, and everybody in between. So I'm sort of the chief fundraiser, the general partner of the fund, also the chief investment officer. I climb on roofs and climb under HVAC systems and negotiate loan agreements. And so that's really the fun part of what we do. And we think it's a great business model for hospitality.
That's a lot of hats, Gary. So you've been in the real estate business since 1990, so you've seen a few cycles, but I'm guessing you've never quite seen anything like the impact of COVID. I mean, you were mentioning earlier that March of last year, you thought the world was looking good, and obviously the whole thing was turned on its head. So, I mean, just give us a feel for, how you sort of saw COVID coming and how you reacted to it, and what's sort of been the priorities and the challenges ultimately.
Yeah, it's sitting here today, April, I'm obviously feeling a lot better about our business, going forward, and hopefully that stays. But I will tell you that we didn't have global pandemic in my business plan. We just didn't have it. And if you asked me about a global pandemic in early March of last year, I would have been like, maybe I heard a TED talk about it or something like that, but I never really thought about it from a business perspective. Being in the real estate business for as long as I have, we're obviously used to the cyclical ups and downs of an economy. And I think that's one of the things that pushed us into the university hotel business, because we thought we could insulate ourselves from that a bit more than we could if we were in traditional markets. And in the past, the recession in the early 90s, obviously what happened after 9/11 and then the recession in 08, 09, obviously 9/11, we didn't have any notice, obviously. But, I remember in the early 90s when I was just getting started in real estate, and there was a real estate recession. And then in 08, 09, obviously it happened quickly, but we did get some notice. We sort of read about it. We heard about it. Two quarters of no growth typically equals a recession, right? So I think in recessions, at least the ones I've experienced, you sort of had a little bit of notice. I think with the pandemic and COVID in March of 2020, we heard about it a little bit in January, a little bit more in February, but I don't think any of us really took it or really knew what it meant. And I think when in Pennsylvania anyway, when the governor shut down the economy and then there was the ripple effect everywhere else, our business fell off a cliff, and literally. And the best way I can explain it is, and then I'll get into what we did about it, but at our Hyatt property in State College, which I told you earlier, sort of was exceeding our expectations. I mean, it was literally in my 30-year career as a developer, the best project I've ever done, right? Both financially, and everything else associated with it. In April of 2020, and if we think about March, put ourselves in, go back in time to March 10th. For April of 2020, we had $1.2 million on the books for revenue for the hotel. And that's rooms, that's conferences, meetings, F&B, and everything. And that's not phantom income. That's real income on the books. Because at the time, it was 15, 20 days away. So those reservations were locked in. If you canceled, you weren't getting a refund and things like that. So we had $1.2 million of revenue on the books. We did $37,000 of revenue in April. So we can all do the math, right? We did $37,000 in revenue from 1.2 million to 37,000. So you can imagine the impact on that specific hotel. And you could also imagine the impact on our management company. We get a percentage of gross revenue. That's how we manage our real estate. So you can imagine our percentage on 1.2 versus our percentage on 37. So not only was our properties were like, oh my goodness, what do we do? But from a management company perspective, we have payroll, we have things that we have to deal with. It was a significant blow to both sides of our business. And so what do you do? This was on the job learning, right? What do you do when your business literally goes like this within a matter of a week or two?
What did you do, Gary?
What did I do? I almost want to try to forget about that. But here's the benefit of our business model. The benefit of our business model is that every general manager that we have, I hired. Most people in those hotels I know. Most of the people I have relationships with. So, we obviously acted very quickly. Unfortunately, we had to lay a lot of people off and furlough people because we just didn't have any business. And those people were housekeepers and front desk people, hourly wage earners. And it was obviously really tough for me personally because I know a lot of those people personally. And that's what I like about the business is connecting with those people at all levels within our business. We had to lay a lot of people off. Fortunately, we were able to work out furloughs on our debt. So we got a lot of our debt relieved for the second quarter of 2020. We were able to do that pretty quickly. Our lenders worked with us, which was great. And we sort of buckled down. The one thing that we did differently than most hotels, a lot of hotels closed. We didn't close any of our hotels. But what we decided to do was we decided to keep our management teams on the property. And again, because we're a smaller company, we're an owner operator, we were able to keep our key management folks in the property. And you know what? They cleaned rooms, they swept the floor, they shoveled snow. But what that has enabled us to do as we started to come out of the pandemic in the last few months, and even in college towns, our business picked up again in the fall and back again in January, February. But it enabled us to sort of rebuild our teams quickly. So a lot of people, kept the assistant general manager and one housekeeper, and they sort of let go of their management teams, and rebuilding those teams and bringing people back to the property was going to be more difficult. So we shrunk our teams at the property. We worked with our lenders. We were at 5% occupancy in April in a lot of our, and because we were in college towns, most of our customers were foreign students that were at the universities from places like China and India and other parts of the world where they didn't want to leave the country because they weren't sure if they were going to be able to get back in. But dormitories were closed and places like that. So we stayed open. They came and stayed at the hotel. So we kept our hotels open. We controlled costs as best we could. Obviously, some costs we can't control. Obviously, the local municipalities continue to expect us to pay our real estate taxes. We had to pay for insurance. Now, obviously, our revenues were way down, so we had some savings in insurance, but we basically shut floors of the hotels down. We were operating on one floor, maybe two floors, and that was it. So we shut the floors down, we turned the thermostats down, we turned the lights off, and we tried to control costs like that, and then manage our customer base in a smaller portion of the real estate. So we were really entrepreneurial, and I think it enabled us to sort of outperform other hotels, in any kind of market. And I think that really benefited us. And because we kept our managers in the building, and as we've had to rebuild and rebuild our frontline employees. We were able to do that more quickly, and we were able to grab more talent that way because we had our teams in the building, our management teams in the building. So it was wow. It was one of those things where you just sort of had to deal with it. There wasn't any real planning, and until we really saw the government shutdowns and the government restrictions, which happened very quickly, we didn't really understand it until it really hit us. So it was really difficult. It wasn't easy. And again, we didn't have it in our business plan. So I think the one comforting part for me as a business owner and the person that raised the capital that invested in these assets was that it wasn't in our business plan. It wasn't something that maybe I should have been ready for, right? And so I said, I obviously felt very responsible for our assets and my investors, but at the same time, my investors were also really supportive as well. And I think that helped. None of my investors were, banging my door down, asking me to redeem their interest in our assets, or, saying I wasn't doing enough, or we as a team weren't doing enough. And I think we communicated a lot with our investors as well, told them what we were doing, how we were doing it. We ended up getting PPP loans for all of our hotels. We just got our second round of PPP loans as well. We got an EIDL loan for one of our assets. So we really tried to take advantage of as much as we could.
You touched a little bit on how you sort of responded from your competitors. So most of your other competitors closed, and they're sort of trying to pick up the pieces from that, are they?
Yeah, a lot of hotels did close. And I think, because it's an operating business, it's not like you can close and then open the next day and be back in business, right? You got to get the building ready. If the building was shut down, you've got to get it clean. You've got to make sure that hopefully you kept the air conditioning and the heat running to keep the modest temperatures, the humidity out of the building, and things like that. So it's not something you can just jumpstart right away. Keeping our hotels open and minimizing our room count and things like that really helped us. For example, at Penn State and Syracuse, they own hotels as well. So we compete against university-owned hotels, and those hotels were shut down. So again, the shutting down of other hotels obviously reduced the supply of hotel rooms that were available, and having the best properties in those markets helped us get what business there was in the market.
You've obviously been having to operate the business a little bit differently, sort of through the pandemic. I mean, is there certain aspects that, in terms of the way you're operating it, that you think are going to continue as we sort of come out of the pandemic and it returns to sort of business as usual?
If anything, the pandemic was a tremendous learning experience. I'm not sure I want to go back and learn it again anytime soon, but I think we learned how to be better operators, right? And obviously our goal before the pandemic was to maximize revenues and control costs and things like that. And I think we've become more hypersensitive to that because of the pandemic. And one of the things you have to be careful about in hospitality is that you have to manage revenue and costs very carefully. So we can cut costs really easily in the hospitality space because we have a lot of variable costs, especially in payroll. But at the same time, you have to be very sensitive to guests. Listen, we're in the hospitality business. We want people to have a good experience when they come to our hotels. If we cut costs too much and we don't have the right amount of staff, we're not going to be able to provide that experience. So we have to be really careful about that. So I think we've learned a lot during the pandemic, and we've learned where we should spend money, where we shouldn't spend money, where we can cut costs, but also maintain a level of quality. And I think that's something we've learned, and I think we'll continue to do that. And I also think we learned that, in some ways, when you're really successful and you have a successful hotel, you sort of rest on your laurels a little bit, hey, we're going to be busy no matter what. If we slip a little bit in customer service or guest scores, it doesn't really matter. We'll continue to get business. And I think we learned that we can't rest on our laurels maybe as much as we used to. And we have to be more grateful for our customers and grateful for the business that we have. And I think it was very humbling. I think, we think we're pretty humble anyway, but in a sense that, I again, we try to under promise and over deliver with our investors and our customers, things like that. But it definitely was a very humbling experience for sure.
When the pandemic hit, I think there was a school of thought that the likes of Airbnb were going to get, very badly hit. And I think they were initially, but they've sort of seemed to have done actually reasonably well through the crisis. I mean, how do you see them as a competitor, both to your business and more generally across the hospitality world? And are they a real threat to you, or do you see them as just a normal competitor?
It's Airbnb has been around for a little bit of time now, right? It was in place before the pandemic, and it's always been something that we've always had to think about. It's certainly a new category of competitor, but I would tell you that at least from my perspective, we haven't seen a huge impact to our business from Airbnb or VRBO or any of these sort of house sharing business models. I think it takes a segment of the business, but it doesn't take the segment that really is sort of transient hotel room business. And I think during the pandemic, just to touch on that briefly, people are really concerned about cleanliness and standards and things like that. And I think there's probably more trust with the big flags, the Marriotts, the Hiltons, the Hyatts of the world, that those standards would be implemented and maintained. And I can tell you that they have been, and we have Marriott, Hilton, and Hyatt within our portfolio. So, they've been all over us about cleanliness and things like that. So I think that's a little bit harder to deploy in an Airbnb model because, you have a million owners, obviously, one owner for every property for the most part. But I think the Airbnb segment or the house sharing segment will continue to do well. But I think it's a different segment of the business, and I think longer term stays, more, especially not so much in the U.S., but bigger cities, bigger markets, like in the U.S. Markets like New York, San Francisco, Miami. I think Airbnb is going to have a bigger impact on those markets than more so than the college markets that we're in. There is a specific company called Rent Like a Champion, and they are a home sharing business for college towns for football weekends. Mm. And so I think they've done relatively well. I think they were actually on Shark Tank, and they got some money from somebody on Shark Tank. And I think we've seen them in our college markets a little bit, but it's really just for football weekends and maybe graduation weekend where they're getting a lot of business. And for those weekends in particular, we're busy anyway. So it hasn't really impacted our business that much.
Yeah. And as we sort of come out of, as you say, businesses looking up now, I mean, how do you see the real drivers for the return of business in terms of business versus leisure, in the hospitality space?
So I think, in hospitality, there's the segments of properties are really different. So you could have a resort property on South Beach in Miami. You could have a full service hotel, in Midtown Manhattan. And then you could have a hotel in a small community along a transportation corridor where you're grabbing people that are driving from point A to point B. And then you can have properties like ours in college towns, right? So I think the recovery in hospitality is going to come from different places, and it's going to happen at different paces for those different property types. I think the drive-by markets, if you've got a Hampton Inn on I-81 in the middle of Pennsylvania or upstate New York, there's going to be a lot of drive, vacation, and people going on vacation and driving. So those hotels may do really well this summer and in the spring and into the fall. I think the Midtown Manhattan, the big urban hotels that depend on business travel, conference and meetings, I think those are going to take a lot longer to come back because where I live in Philadelphia, suburban Philadelphia, I mean, a lot of the hotels in downtown Philadelphia depend on the conference center and the convention center for their business. I mean, I'm not sure when we're going to have 10,000 people come together for a conference and convention again. So I think those hotels are going to struggle a little bit more to come out. I think from a vacation perspective and people that are coming to Philadelphia to see the Liberty Bell and Independence Hall, I think those hotels will do better. But if you've got 1,000-room hotel next to the convention center, that's going to be a much tougher climb. For us in the college markets, we think the fall, and sort of the way I look at the calendar is a little bit different than most maybe. I look at the calendar in a college year calendar. So August to May is sort of how I look at my markets. And we think, assuming we continue on the same path with vaccinations and things like that, we think the fall of 2021, meaning August of 2021, which is not far away, is going to look somewhere between 80 to 90% of the fall of 19. So when we went into the fall semester of 2019, things were great, right? College campuses were really busy, sporting events, social events, clubs, organizations, professional recruiting. That was all we were really busy in the fall of 19. And we think we'll get somewhere, call it 85% of where we were in 19. And I think if we continue, the fall of 22 will be back to 100%. So we think our climb out of the pandemic for our assets is going to be much quicker than some of the other categories.
And I know as part of your portfolio, aside from the hotels, you also have got a small office portfolio. I mean, obviously that's a very different dynamic than you're seeing in the hospitality world. I mean, what's your perspective on that, and how do you see that sort of coming out? I mean, obviously everyone's been working at home to date, and so there's a lot of uncertainty around the office market.
Yeah, and I'm not sure we really know yet. What I would say though, for us, we have pooled asset funds. So the fund owns the assets in that particular fund. So we're really fortunate during this time that we do have office assets in our portfolio, because during the pandemic, we've collected 99% of our rents. So when you have pooled assets, they can sort of ebb and flow against each other. So as our hotel revenues kind of bottomed out pretty quickly, we were still collecting our office rents. And in a way, our office assets and the revenues and the cash flow from our office assets were helping sort of stabilize our hotel assets. So that worked really well for us, at the peak of the pandemic. So I would say that our strategy of hedging office and hotel works pretty well. It worked really well in the 2008 recession as well. I think for office assets, again, it's going to depend where you are. I think office assets in dense urban communities are going to take longer for people to come back to the office. I think suburban office, it's going to happen quicker. And I also think it's going to happen quicker where commute times are shorter. So if you live in a community where commute times are really long, you may stay home. Ultimately, I think it's going to shake out with a hybrid model where I think some folks are going to work at home a day or two a week, maybe Mondays and Fridays, where commutes are a little bit tougher, and maybe come into the office in the middle of the week. And I think that's probably where we're going to shake out. The other question is, are companies going to grow the amount of office space they have or shrink the amount of office space they have? I think pre-pandemic, we were seeing smaller floor plates for tenants because people didn't want as many private offices. People were moving to open office floor plates. Nobody has a private office anymore. You have little work rooms or hotel rooms, or not hoteling in the office space business. And now we're thinking, or there's articles and people are talking about, well, we're going to go back to private offices because people want to be able to not be in the middle of a room with 100 people, right? Mm-hmm. I think the jury's still out, and I think it's going to depend on if you're in an urban setting or you're in a suburban setting. I think it's just going to depend. We have suburban office buildings, and so I think we'll probably do a little bit better than if we had all urban office buildings. So I'm pretty optimistic about office space. I think we have built, our office buildings are more boutique, and we don't have really large tenants that dominate one building. So a lot of our tenants are 3,000 to 7,000 square feet. Accounting firms, law firms, businesses like that, which we think will sort of come back to the office. So,
sure. Gary, you mentioned earlier that your investors were very supportive as you were sort of struggling through the pandemic. I mean, what's the sort of feeling you're getting from them now in terms of, do they have appetite for new investments, or are they still sitting on their hands? What's the sort of temperature amongst your investors?
Yeah, again, I think because of our business model, and I know a lot of our investors. I have a relationship with them, and we communicated a lot with them during the pandemic and the early parts of the pandemic. The fact that we were keeping them informed, we were being very transparent, kept them on our side. And they saw that we got the PPP loans. They saw that we got an EIDL loan. They saw that we shrunk our payroll costs and things like that. So I think they were supportive because we were really working hard to keep our head above water. And the other part is I have relationships with my lenders as well. So I could pick up the phone and call them, talk to them, and they can talk to me. And I think that's really important in the real estate business. You might see a lot of people in the real estate business that use mortgage bankers and leasing brokers, and you see a real estate deal getting done and there's like 16 people listed, that needed to get the deal done. I think any developer, in my opinion, I do a lot of that. We do a lot of that ourselves internally, because it's important that we have relationships with our investors. It's important that we have relationships with our lenders. And I think that helped us get through the pandemic better than most. There's a lot of money on the sidelines right now, looking in the real estate space, looking at all property types. I think the only property type that wasn't harmed during the pandemic was if you had a large portfolio of industrial warehouse buildings. You probably did better than certainly if you owned hotels and office and retail. There's a lot of money on the sidelines, waiting for distress, waiting for opportunistic investments. And this happened in 2008 as well. And what happened was, in 2008 anyway, is that the government sort of kept the economy afloat, right? Really low interest rates, a lot of government bailout money. And we really never saw a lot of distressed buying opportunities in 2008 and 2009. We just didn't see it. We had capital. We ended up using our capital to buy back our own debt in 2008 and 2009 because we could buy that a lot cheaper. We got lucky in a way that some of our lenders at the time were really struggling, and they were starving for cash. So the best use of the dry capital we had back in 2008 and 2009 was not to buy new assets, but to buy back our debt at 50, 60 cents on the dollar. And that's what we did. And that ended up really benefiting us in the long run. I think in this case, we're not seeing the distress at the bank level, obviously, because of the pandemic. The government is keeping the economy afloat. And if you look at the stock market, wow, you wouldn't even know that there was a pandemic, frankly. Interest rates are really low. And I think you're going to see, sort of a hockey-shaped curve, if you will, or growth in a lot of things, especially hospitality and in a lot of markets. I think you're going to see some steep climbs for certain hospitality markets, leisure. There's a lot of pent up demand for people to go on vacation, to get on the beach, to get on the slopes, to do things like that. So I think you're not going to see a lot of distress, because I think a lot of properties are going to start coming back quickly. And as long as interest rates remain low. The other thing that happened in the early parts of the pandemic was, I think the government and the banking regulators, both at the federal level and the state levels, sort of backed off the banks, took the pressure off the banks from a standpoint of performing loans, non-performing loans. And I think that helped as well. So I don't think you're going to see a ton of distress. I think you'll see some. And I think the ones that do come out, it'll be like a feeding frenzy to try to grab those assets. But again, I think for us, we're going to stick with our business plan, which is real estate fundamentals, location, finding those properties that are supported by major colleges and universities, and try to pick off those deals. But I think that the distress is going to be limited. And I think the opportunities are going to be somewhat limited, because I think as we come out of this, hopefully, if we continue to come out of it, I think the distress is going to be somewhat limited.
And you mentioned you had, I think it was 3 properties under contract. I mean, would you go back to those, or is there a different sort of deal you'd want to do now than you would have done, say, 12? 13?
Yeah, I think we would, and we are. We've sort of rebooted our acquisition process. We've looked at a couple of distressed deals over the last few months, and we ended up putting some offers in, but ultimately the buildings didn't sell. They ended up keeping the current owner, and the lender reworked it. Maybe that investor got their current investors to put some more capital in the deal and things like that. So we are rebooting some of the deals that we had under contract pre-pandemic that we terminated. And we're looking for new opportunities now. We have some capital to deploy. And, we're going to continue to be careful. As a smaller company, we're not a volume investor. We're a quality investor. So we're looking for those really good deals, really good opportunities where we can create value, where others don't see it. And that's what we're going to continue to do.
And we're sort of getting, so we'll maybe try and get to some of the questions in the chat in a minute. But I mean, just before then, so what's your sort of outlook for the hotel market over the next 24, 36 months? I mean, how do you, I mean, I know, yeah, your crystal ball may be a little bit misty these days, but how do you sort of see it playing out over the next couple of years?
It's hard to prognosticate, beyond what, in the hospitality market. It's hard to sort of look forward too far. Like I said earlier, pre-pandemic, if you were in a convention market like Chicago, Philadelphia, where you have big convention hotels and, people book these large conventions and conferences years out, right? So pre-pandemic, we knew, what the conference center business was going to look like in Philadelphia and Chicago, New York, out in 21, 22, 23, and 24. Because when you're looking at 5, 10, 15,000 people coming to a market at once, you've got to do that many, many years in advance. Same thing with leisure. If you want to take a vacation with your family or do a corporate retreat, if it's a small one, you're doing that a year out, right? People are booking their Christmas vacations now. They're booking their ski vacations for February or March now for next year. So in certain markets, you can look out a year or so. I think the leisure market, looking into like Christmas, New Year's, and into the next winter for warmer climate vacations, I think is going to be really strong. I think, again, if you have a conference center hotel in Chicago or Philly or New York, I think you're probably looking at 24, 25 before these big conferences come back. Because even if they decide next year, 22, all right, let's get our 15,000 person conference in Las Vegas or Philadelphia, they're going to book it 2 or 3 years out because they need that much time to plan it. So even if next year they decide to get back on the horse, those conferences aren't going to happen until 24 or 25. So I think, and then in smaller markets like us, the booking windows have shrunk. They were shrinking before the pandemic because it's so easy to make hotel reservations now, both on the flags, if you go to Marriott.com, Hilton, Hyatt.com, but also on hotels.com. And, there's a website called Hotels Tonight. You can book your hotel that night, so technology's enabled the booking windows to shrink significantly. So a lot of times we see pickup by the week. We thought we were going to be 65% occupied this week. We end up being 75% occupied. So it's a little bit harder to predict these days. I think in our markets with college demand, we're able to see it a little bit clearer than most. So that's sort of my prognostication. It's probably as far as I'll go. So.
Sure. So I don't know if Richard or Mona has been monitoring the chat room. Is there any questions out of that we want to pick up? Or?
No, I've been monitoring the chat rooms. Well, there were a couple comments about good members of Penn State. That who was it? Steve had one about his daughter there. He might want to add. So
you have to notice I'm wearing blue and white today.
I just shared that my daughter is attending Schreier's there at Penn State.
Oh, great.
We've visited, we've stayed at your Hyatt facility quite a few times. Love that Federal Tap House. It's one of our favorite restaurants.
Thank you.
So,
yeah.
I guess I actually had a question as well. It seems like REITs or funds and ETFs are at an all-time high. How much of that's driven by commercial demand versus residential demand? And do you see this work from home impacting that sometime in the near future?
Boy, these are great questions. And again, these are my opinions. We don't really know what's going to happen. Obviously, we can plan for various scenarios, but the work from home issue, the work from home opportunity is a big one. For me personally and my company, working at home is not a great option for us. because we want to interact with each other. We want to be in the same building and we want to talk. I want to walk into somebody else's office and talk about a project or a situation that we have to manage. Doesn't work as well. I would much rather be with all of you in person and shake your hand and talk to you, look you in the eye. That's a much better perspective for me to share information and to meet people and to network. I can tell you, because I'm involved with younger folks, students, and people that are maybe in their first job in an apartment, working from home is not great. That social aspect is gone. And I know I have two nieces that live in New York, in efficiency units, and they've been working in their one little room, and they're going a little nutty, right? So certain people want to get back into the office and they want to get out of their apartment. So I think ultimately, we're all humans. We have a human nature that we want to be social and interact with other people. So I think again, I'm a fundamental, basic investor, so I don't think the fundamentals will ever go away. So I do think people are going to get back to the office. I do think people are going to want to get out of their apartments, but I think development's going to change. I think you're going to see apartments get developed maybe a little bit differently, because I think if there is another pandemic, and I hope there isn't, that maybe these small little tiny efficiencies, maybe that changes. I can tell you that before the pandemic, when we developed our property in Syracuse, we redeveloped it. We really redid the whole thing. The rooms in that building are a little bit smaller. So we made sure that we developed our lobby to be very welcoming for guests to spend more time in the lobby, to be able to work or gather in small groups or pods in the lobby, so that they're not spending all their time in their hotel room. So that, because the rooms are a little bit smaller, we made sure that we developed and designed a lobby that was a little bit different than maybe we would have designed it differently if the rooms were really big. So, that's been a challenge because the rooms are smaller. The lobby was designed for gathering and socializing. And ultimately, I think we're going to get back to that. But I think, I'm not in the residential business. I don't own any multifamily housing or student housing, but I continue to scratch my head about how many apartments are being developed and through the pandemic, and new construction starts on apartments, permits being issued for new apartment development. So if you ask me, like, would I invest in a multifamily deal today in a market like Philly or DC or Boston, I'd be like, I'm not sure where that demand's going to come from. Obviously, they've proven me wrong, because these buildings are filling up, and perhaps it's a flight to quality. Also, the older buildings are getting left behind, and the older products getting left behind. But I think you could say that about any property type in any market, right? New properties are always going to sort of outpace older ones. Better located properties are always going to outpace lesser location properties. So again, the fundamentals are always going to win.
Thank you.
Yeah, I have a question, Gary. So you mentioned the fundraising part of your business, whether it's a fund that you've built or angel investors, whatever. Any recommendations you have for anyone who's looking to raise money, whether it's a fund or startup or whatever, lessons learned in your years of doing that kind of work? So just a few good ones.
Sure. So in the real estate space, your track record is obviously really important. And because we're in the hard asset business, we can point back to projects that we've done. And I would love to tell you that every project I've done has been a home run grand slam, but they haven't been. And I think so. One, you have to be realistic. Two, for me, I'm the fundraiser. So I would go on my road shows and meet with investors and have presentations and meetings. And it was important that they knew our strategy and we clearly defined it. But what we found, aside from trying to find good deals and investing money smartly, I think the thing that's helped us the most in our fund business and raising capital is, one, transparency and reporting. So being a former CPA, I guess you'd call me that, we're very focused on on accounting, right? Making sure we get our accounting and financial reporting done properly. All of our funds go through, GAAP audits at the end of the year, but we do quarterly financial reporting. And some investors want to see reports every month, so we try to accommodate them. We don't have billion-dollar funds. Our funds range from $20 to $50 million. So, but we have a lot of investors in some of those funds as well. So we try to keep on a schedule, but at the same time, if an investor says, boy, I'd love to see something monthly from you, we do it. So I think our flexibility with our investor base is important, and transparency is really important. So not only do we talk about the things that are going right at our properties, but we also talk about the things that aren't going as well as we'd like. But the one thing that we do, if there is a bump in the road or something like that, or things don't work the way we want them to work, that we're transparent about it. But we also talk about how we're going to solve the problem. And we always try to have more than one option to solve the problem. So for example, we've got an upcoming vacancy in one of our buildings. We know it's coming later this year, and we're actively working on filling that space. And as soon as we got the notice from the tenant, we notified our investors, even before the quarterly reporting cycle. I sent an email out and said, I hope everyone's doing well. We just wanted to let you know that we're going to be losing this tenant, and we're actively working on backfilling it. So the fact that we're doing things like that, I think, has really helped us the most, to be honest.
And just on that, Gary, where have you typically found your investors from?
I think it's changed. It evolves, right? So, our first fund was actually less than we had about just under 20 million of commitments. We ended up only investing about 14 million of it. And we started out with a lot of high net worth individuals, a couple of family trusts, estates, and things like that, where we got our investors from. And then the next fund, we had almost 100% participation from our first fund. But then we grew it with some more institutional investors, some more investment partnerships that we were able to connect with. And then the third fund, we ended up getting a big institutional investor as well. And that helped as well. So it kind of evolves, over time as we build our track record, we build our reputation, and that's how we've done it. But our goal is to stay, we think to be successful in hospitality, we've got to be a hands-on operator, which means I can't have 300 hotels and be a hands-on operator. So I'd rather have 15 hotels and be a hands-on operator and be really successful with those 15 than to try to manage a big portfolio and lose connection with those assets.
Richard, do you see the
Andy,
last one?
I have a question, I don't know if you don't mind. Gary, the first question I was going to ask, Andy kind of asked in the beginning when you started out at State College, the brands and the level of hotel. So the minimum service hotel, that made perfect sense. But when you get involved with a major brand like Hyatt, as opposed to your own brand, what's the relationship? Who's the boss? Are you the boss of them? Or are they the boss of you? Is it a true partnership? That seems a little like it could be confusing and convoluted.
Yeah, I think there's a lot of confusion, in the public about hotels. So, some people will say to my wife, what's going on with this? Are these people employed by Marriott? Or are they employed by us? So it's a convoluted relationship, and it's one that a lot of the buying public doesn't really understand. So in a hotel flag franchise, we're really a franchise. So let me take a step back. We're a franchise. So at the Hyatt in State College, we signed a 20-year franchise agreement with Hyatt, which means we get to use their name, we get to use their brand, we get to use their reservation system, we get to use their loyalty program, and then we pay them to be part of that infrastructure. But we own the real estate, and we own and we operate the building. So everyone working in the hotel is employed by our hotel management company. So it's really a franchise. Hyatt, in that particular case, doesn't own the real estate. They don't employ our people, but they have a thumb on our back that says, you have to design your rooms this way. You have to use this furniture. You have to use this wallpaper. You have to, your employees have to wear these uniforms. And, you know, they control, you know, our refund policy. They control a lot of those things. And I would tell you that my franchise agreement with Hyatt's probably about 100 pages. And 98 pages of it are things that we have to do for them. And 2 pages are the stuff they do for us. So I would tell you that as you know, as you know, a little bit of a control freak in our business, you know, that's probably one of the hardest documents I have to sign because it's a very lopsided contract, and it's non-cancelable. You know, we have to do what they say. They can put us in default, but we can't put them in default. You know, so it can be a tough document. However, if your hotel is successful and you're making money, you know, it's an easier document to manage. And in some ways, it's one of those documents that for a big project like we did in State College, like I said, our lender required us to have a flag. So it's one of those documents you hope that you can put in the drawer and not really worry about it too much and not have to take it out of the drawer unless you really have to, you know, figure out why they're, you know, sending you a default letter or why they're telling you your guest scores stink. And if you don't get them better, you know, they're going to put you in, you know, in special servicing or something like that. Right.
With the franchise agreement, it makes more sense now because I'm 3 weeks into being a franchisee in boutique fitness and my franchise agreement's that thick, the lease document's that thick. And I said the same thing. If everything goes well, I don't need this document. If something doesn't go well, we're in trouble.
Yeah. I'm sure there's a lot of similarities between that. And hopefully you'll benefit from being part of their family of locations and that drives.
And that was my, you know, unrelated to hospitality, that was my decision to go forward. They had a very good oversight structure.
Yep.
So
yeah,
thanks, appreciate it.
And in some markets that can be really important, right? In some markets it's less important. Like we think, and the reason we started Scholar was because we think the brands, the big brands, are less relevant in these smaller markets that are dominated by these big universities, because we know exactly where our business is coming from. We know when we're going to be busy. We know when there's a big event. We know, especially like a school like Penn State that has business, engineering, nursing, sciences, that they're doing research and development with Fortune 500 companies, with the United States government and things like that. So, you know, when you know where your business is coming from and you sort of know what the schedule is, you know, having that big pipe of reservations coming into your building is a little bit less important and less relevant.
Thank you.
Gary, just to piggyback on what you've been saying, there's a question here that says, for a market like State College, I believe you're correct in surmising that brands are much less valuable. While there's a lot of data to back this up, bankers still have trouble getting comfortable in financing a hotel without a flag. Why do you think this is?
Yeah, certainly for a big project like we did, ground up construction where there's a lot more risk involved. Yeah, it definitely gives a lender a little bit of comfort because in a way, you know, it's there. Obviously, there's no guarantees, right? But it gives the lender the sense that, hey, the Marriotts and Hyatts and Hiltons of the world are going to bring business into this hotel, and knowing that they're involved gives them comfort. We just opened a Scholar Hotel in State College. It's about 3 blocks away from the Hyatt. It's only 72 rooms. It was an existing historic building. We renovated and redeveloped a historic building. We did state and federal tax credits, which are really great. But we have a local, community bank that lent us our construction financing. Didn't care if we had a flag or not. They knew, obviously we had success down the street with the Hyatt. So we had a little bit of a track record in the market. People know me in the market. They knew what we did there. So they were very comfortable lending us the construction financing we needed to renovate this property, albeit much smaller. And from their perspective, much less risk because of the size of the project, the location of the project. In addition to that, here's an interesting story. Because we were doing extended stay hotel rooms, their perception of risk was, well, if this doesn't work and we've got to, take over the asset, this could be student housing. You could almost convert the building from like an extended stay hotel into student housing. And by the way, you're about 100 feet away from a 50,000 student university. So, they were pretty comfortable with the downside risk, if you will, from that perspective. So we were able to get that from a local community bank. Same thing in Morgantown. In Syracuse, because it was a bigger project and a bigger lift on construction, we ended up with a national bank there. But again, scholar branded, national bank, great location in between the university and a major hospital system. The perceived risk was low. Now, this all happened before the pandemic, by the way. So.
Well, I think we're nearly out of time, Gary. Is there anything else you'd like to add? Really appreciate your time. It's been a great discussion.
Yeah, I really enjoy the interaction. So thank you for having me. If anyone wants to connect with me, I'm on LinkedIn. I'm happy to connect with anybody and have a sidebar conversation if you'd like. And I would say, overall, we're optimistic. You have to be optimistic, because if you can't be optimistic, then it's tougher to get out of bed in the morning. But I think why we're optimistic is because I think we made really good investments, before the pandemic. And we think, by sticking with the fundamentals, being a real estate first company strategy, and then coming in with our operating team on the management side and executing the crap out of it, is still the right model. And I think because we don't over lever too much on our hotel assets, we have moderate leverage. We've got well located, fundamentally strong real estate assets and a great operating team. I'm really optimistic about how the rest of this year is going to play out and how 22 and 23 look from here. So hopefully everyone's getting vaccinated. Hopefully everyone's planning a vacation, or if you have kids or grandkids, your grandkids are going to be back on campus in the fall, and they're going to have a great college experience. I know I'm hopeful for my own kids. So
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.